It is our pleasure here to have Stephen Terry. He is a macroeconomist and with a PhD from Stanford, if I'm correct, and currently at Boston University. I mean, he has numerous publications in fantastic venues like Econometrica, American Economic Review, Management Science. So I'm pretty sure he will give us a very interesting, book. So the rule is that, we are going to have 5 minutes with Stephen, to introduce us to the topic, and then we can ask questions. I mean, you can ask questions by writing up on the chat box, okay? And I will be observing that, and I will flag them to Stephen as well. And then we are going to have 5 minutes uninterrupted at the end of the presentation to give the opportunity to Stephen to give us a conclusion and a connection with the accounting project. Thank you.
Perfect. Thanks so much for having me here to the organizers, and thanks so much, Christina, for moderating the session today. I appreciate it. So I'm excited about talking to you about the macro impact of short-termism. The macro part is where I come in as a macroeconomist, which is potentially an unusual choice of researcher for this venue, but I'm really excited to present this to some accounting researchers. I have had the chance to do that in the past and kind of present this in front of accounting audiences, and each time I do, I learn something new. Okay, so I'm very much aware that this is your space and that I'm here as a person that wants to learn from you as accounting researchers. That also means if you ask a question, don't necessarily assume that I know the answer if it's something that sounds like inside baseball to you, okay? So I'm gonna treat this as an experience to learn from you as well, but I'm excited. So let's dive in to talk about short-termism. Okay, so short-termism, incredibly broadly defined, has long been of concern to researchers and policymakers and commentators. So Alfred Marshall in the 1890s was saying that people act like children that pick the plums out of their pudding to eat them at once. More recently, kind of managers or kind of managerial consulting commentators and people in that space have been kind of worried that management has some sort of shorter term horizon, especially given the fact that there are long-term investments out there that we think might need to be made for the sake of either individual firms or the economy as a whole. Okay? This is a broad area, this broad thought about the potential presence of some sort of short-term pressure on companies to produce profits, which is what my particular notion of short-termism means. Let me zero in a little bit and show you one figure that just encapsulates, and this will be a familiar figure to you as an accounting audience, but it kind of encapsulates the space in which I am going to be discussing kind of short-termism. So this figure is a histogram of earnings forecast errors. Okay, so this is familiar to accounting audiences, less familiar to econ audiences. But what we have here is, a panel of about, over the last 30 years or so, at the firm fiscal year level, information on firms reported or street profits or street earnings, minus consensus analyst forecasts, scaled by firm assets. Okay? And what you see here is that this histogram of forecast errors, as is well known and has been as the topic of much study in the earnings manipulation space, has a discontinuity around 0. Okay, so some things should pop out to you about this type of distribution. One, there are a disproportionate number of firm years in which firms have forecast errors just at or to the right of 0. In other words, these are years in which firms report earnings that just meet or beat profit targets as embodied in analyst consensus forecasts. And there's a hollowing out of the distribution below 0. So on its face, these types of patterns are consistent with the idea that firms face some sort of pressure to meet earnings targets like analyst forecasts, and that they take some sort of action, whatever that action might be, to deliver profits above targets when possible. Okay, it's kind of broadly consistent with that idea. Okay, and by itself, that's something that's long been a focus for the study of earnings manipulation. But at this point, it's worth kind of pausing for a moment and asking, why am I talking to you about this? Okay, like why would I, as a macroeconomist, care about this? And I think there's a really good reason that I, as a macroeconomist, should care about this. Okay. And in particular, it's the case that, and this is just some motivating survey evidence, the point of the paper is to justify to you why I care about this. It's the case that as a macroeconomist that cares about firms, I might want to care about this topic because managers say they care about this topic. About 90% of managers in surveys say they care about meeting earnings benchmarks, kind of delivering short-term profits above targets. And here's where I get really interested as an economist. And as an economist that studies individual firms and their aggregate implications of frictions, it turns out, and this is something I have to tell economists, it's not incredibly well known, it turns out that R&D, very long-term investments, are expensed from earnings. They come straight out of earnings, with some narrow exceptions. Okay, that should get every economist's attention because R&D, innovative long-term investments, is what the entire econ profession views as the source of innovative increases in productivity that drive increases in living standards over time for individual economies and the globe as a whole. And almost 40% of managers say they'd reject a positive NPV project if the project met missing targets, according to the very famous survey paper. So this means, potentially, that there is scope for some firms in some periods to do things like engage in a form of real earnings manipulation, cut their R&D investments to meet short-term targets. And if those R&D investments are important for macro or overall real economic growth, there could be a trade-off between this short-term discipline and long-term investments. And that's why I got interested in this topic to begin with. So what do I do? And this is all just kind of, setting the mood music a little bit. I do 4 things in this paper. Okay, so everything I do and find in this paper is on this slide. Okay, so if we get through this slide, all of the power goes out in Boston where I am, and we don't see anything else, that's fine, because everything I'm doing is here. So the first thing I'm going to do is I'm going to tell you a little bit about the macro data set that I'm using, and I'm going to show you some differences in means. I'm going to show you that those firms that just meet or beat earnings targets, these analyst forecasts, have discontinuously lower long-term investment growth, their R&D growth, their SG&A growth. It's all systematically lower. And these discontinuities, these differences in means just around earnings thresholds, are consistent with the idea that indeed systematically some firms do cut their long-term investment in some periods to boost profits above targets. I'm then going to show you, using that same strategy, just showing you differences in means around a threshold, that seems to make sense in terms of the incentives facing these firms and managers. CEO compensation is kind of discontinuously higher for firms that meet or beat targets. So are the stock returns of their firms, which is, of course, something that's been long been a focus in this space. So those are just some facts, some difference in means, kind of some suspicious discontinuities consistent with the idea that there is rampant real earnings manipulation along the dimension of R&D, which macro people like me consider to be meaningful for driving growth. So with these facts as motivation, the second step of the paper is to build a model of this phenomena. So the model is going to be a GE endogenous growth structure. So insert macro jargon is what I just did. So what is that? So that's a general equilibrium structure. So in this context, that means I'll model individual firms and their problems, and then I'll add up to make statements about the economy as a whole in a way that involves in that aggregation fixed points that take care of prices and things like that. Okay? An endogenous growth model is the class of models within macro that think about what R&D does. And I'm focusing on R&D because it's that long-term investments that's expensed from profits on the accounting side. But on the econ side, I care about it because macro people think about it as the thing that drives productivity growth. Innovation, new ideas come from R&D is the idea. And models of this endogenous growth class endogenize overall living standards growth from R&D decisions at the individual firm level. So that's kind of the macro picture. At the individual, oh, please.
Can I have a question, please?
Please, yes.
Before you proceed to the next stage.
Of course.
So this is Stephen Penman. I have a question to you.
Yes, Stephen to Stephen here. The story is that firms, when their earnings are down, they reduce R&D to keep them up to meet expectations, as you say. But there's also another scenario that when your earnings are down, that your past R&D is not paying off well, that you make revisions in terms of the prospects of your long-term R&D. So you drop that R&D down when in fact you're getting realizations that's showing that things are not paying off as well. That is another scenario you might want to think about. Whether you can sort this out from the pure earnings management is another question, but that is another scenario.
That's right. That's right. So when I look in the data, okay, you see firms with high R&D, firms with low R&D. Some of those firms are near earnings benchmarks, some aren't. For me to draw conclusions about that, I need to have some sort of systematic, well-defined concept of what R&D should be. And another way to reflect, and I hope I'm representing your statement correctly, the concern that you're kind of raising is that for some firms, R&D should be low. Okay? And just seeing R&D cuts isn't necessarily an indication that the sky is falling. So the model that I'm going to work with has a couple of sources of kind of shocks at the firm level. One is a persistent shock that drives firm long-term or persistent prospects. And in response to that shock, some firms should be increasing their R&D and some firms should be cutting their R&D. So there's a motive to have both high and low. There is also a shock that represents something more akin to, imprecision in accounting standards and noise in profits. And both of those types of things are going to interact in this model with firms' incentives to engage in R&D. And I'm going to let kind of the broad covariance structure of the data help sort some of that out for me. So the model I'll have.
That's very good. Yep.
Perfect. Right. So thank you.
I have another question.
Okay, perfect.
Or maybe comment or question. I mean, here is the thing, small firms, have, their innovation activity through R&D. But when it comes to the large firms, these firms achieve, their innovation by acquisitions as well. So here is the thing that, what you're capturing in terms of R&D and expense in the structure of the income statement may not be representative of the innovation that, the company has access to. So I don't know how this will work out with your framework there, because I suspect what you are capturing here is for small firms who do not have the opportunity to acquire other firms. They're not strong enough. They're not large enough.
So thanks so much. So one of the joys of presenting this in front of accounting audiences is that over the years, I've learned more and more about the options that firms have at their disposal to kind of influence their earnings and increase their value. And it turns out that there are a range of things that fall under this broad category of kind of tools that firms can use to engage in real earnings manipulation. There are, you could do like cut your prices today to have a sale and boost your revenues. You could kind of put things into inventories. There's all sorts of stuff on that side. There are also a lot of different ways you could measure, and this is exactly what you're describing, kind of firm long-term investment. Okay? And it could be something like R&D. It could be something else like advertising at the firm. It could be, expenses to train your workers. It could be, things that fall into SG&A, but not R&D. It could be, and crucially, and I appreciate what you're saying, M&A activity, especially for large firms that aren't the young bucks that are out there trying to come up with ideas themselves. That could be a type of long-term investment that's crucial. So there's a certain amount I can go in that direction in this paper, and that I have, but there's a limit to it. Okay, so the direction I have gone to try to capture this idea that there are many long-term investment tools, not just R&D, is I've looked, when I'm kind of just documenting these types of discontinuities, at broader measures than just R&D. So I look at SG&A, not just R&D, captures some portion of it. To talk about acquisition, which I agree is important, I would need to think much more carefully about merger and acquisition behavior within the context of a very different model. Okay, and so I think that's important, especially given changes we've seen recently in kind of the life cycle of firms. But it's not something I have the tools to speak about in this paper. So there's kind of a limit to how much I can say about it, even though I think it's a cool idea. Yeah,
it's another paper perhaps. So we have two comments as well.
Perfect, great.
Okay, so we have a comment from Paul Darwin. And this is, about related evidence in the European Accounting Review, which shows that firms tend to cut R&D the fourth quarter, but to make it up in the next quarter. So this is not really a long-term cut. So any ideas about this, evidence and how this works for your data?
So that's right. So that's what I see in this data as well. And I'm also familiar with the idea that these discontinuities are well studied in the accounting space with kind of similar work that dates back to like the mid-2000s. So I also see that these are fairly transitory cuts. So in this particular data set, it's not quarterly R&D, it's kind of firm fiscal year R&D. You see cuts in a year that a firm just meets a target. We're back to about level the next year, and then there's a boost the year after that, which would be what you would expect with some mean reversion and a fairly transitory form of R&D cuts. Turns out that's going to be what my model generates. And that's going to be a source of the distortion that I'm going to describe. So I'll tell you about this in just a second. But basically, the idea that there can be noise added to long-term investment itself creates misallocation. The idea is in this model that you can think about two firms, create them again with ideas. Both of them have the same average level of R&D, and one of them is just jacking up and down its R&D process in response to noise, which is kind of what the model will say happens. Okay? Which one is going to be more efficient? Well, think about your own departments and your own units in business schools. You may have the same mean funding or kind of drive from the deans, but what's going to be more stable for your innovation output process? The one that has the same mean, or the one that has and low variance, or the one that has a dean that's going crazy each year? Okay. More stable R&D leads to basically better outcomes, quote unquote, both in the real world, but also in the context of this model where there's basically Jensen's inequality at work. Okay, so I am going to see transitory stuff in the data. That's how the model works. So I couldn't agree more is the answer. There was a second comment.
Yes, we do have questions from Mayank.
Perfect.
Hi, Stephen. I have two questions. The first question is more high level. So like when you talk about, I think the high level question is, do you think this is kind of like accountants' fault in terms of measurement, like we don't record our long-term R&D activities as investments in the financial report, or you think it's actually more about a problem in contracting, that how come the users of the financial statements do not adjust these R&D expense numbers for their own purpose? In other words, that in the contracting world, maybe they should make adjustments for those R&D expense, because accountants report that in every year, like either in the income statement or balance sheet, but users or contracting parties actually have full information. And then they can kind of like make adjustments to see whether they want to contract based on long-term, for example, 5 years average R&D spending rather than just 1 quarter. And then that would mitigate the short-termness and kind of like incentive or problems, right? So I think my first question is more high level, is that what's the sources of this short-termness and that actually does the harm to the macroeconomy?
Yeah, so thanks so much for that question. I mean, it's multifaceted, and I think there's two kind of important things that you touched on in the question. Let me talk about the first one first, which is, is this accountant's fault? Is this like bad accounting, right? This expensing of what we now would think of as not this ancillary expense, but something that is a core form of investment, and we're treating it very differently from capitalized tangible investment, for example. So this paper and this form of distortion relies on that asymmetric expensing happening, okay? And so in that sense, this mechanism goes away if these things are fully capitalized, or it becomes less important if they're fully capitalized. And so in that sense, accounting affects it. Okay? I have been privileged enough to talk to enough accountants and read enough accounting papers to know there are trade-offs here. So I'm not going to say right there that means R&D shouldn't be expensed, okay? Because there are important questions about how to value intangible investment, for example. And I don't want to suggest that those trade-offs, which are not modeled here, don't matter. So I'm just taking it as given, and you as accounting researchers, tell me whether it's a good idea or bad. I'm talking about the consequences, is my perspective. The second one, I do have something more explicit to say though, Okay, and the basic question, as I understand it, correct me if I'm wrong, is where the heck does this stuff come from? And look, I mean, this stuff appears to basically being showing up in explicit or implicit contracts that a firm could shield a manager from, but it's choosing not to, right? And they observe R&D, whatever, they could insulate a manager from this. I have something to say about that. And basically what I'll show in the paper is that these types of short-term pressures can be beneficial for firm value in the presence of very classic manager agency conflicts, even if they induce R&D distortions and have costs for the macroeconomy. So I view this as something that's very naturally, although I've just talked about consequences so far, motivated by traditional kind of contracting considerations. And in my view, that's likely why firms might not choose to insulate their managers from these types of pressures or change the nature of the metric, as you were suggesting.
Okay, thank you.
Absolutely.
I have a second question. It's kind of more technical.
Perfect.
You talk about that in the model, you kind of model the shocks, like business or economic shocks, to be persistent kind of over time. And then there's a measurement noise. So is the measurement noise somehow correlated across firms in the economy, or somehow persistent? Not persistent, actually it's kind of adjust. There's a negative correlation over time. So thinking about if you cut R&D or something, you boost up your earnings by borrowing something from the future period, there should be a mechanical negative serial correlation in the measurement signals, just because managers move something forward to the current period, and in the future, they mechanically would just have to report something lower in terms of earnings. So are those kind of two elements considered here in the model, or everything is IDD independent across time?
So let me tell you a little bit more about the model structure, but I both understand the question. I think it's an important one, and then I will return very explicitly to talk about that in just a second. So I'll give us all jointly just a bit more information, and then I have an answer to that. I think it's an interesting question and we should revisit it. So let me tell you a little bit about what's actually happening at the firm level. So I'm still kind of describing this second contribution. There's this macro world where all the R&D of the different firms drives macro growth for the economy, and it's general equilibrium. There's households, I can talk about welfare and stuff like that. The richness here is that there's a rich distribution and this continuum of heterogeneous firms. And that's where the action happens, and that's where some of the shock processes that you were asking about are located. So at the individual firm level, okay, I'm going to have firms that face rational forecasts of their own profits that follow them around. These firms face idiosyncratic shocks to their profitability. They face two of them. There's a persistent shock that kind of drives what they should be doing with their investment. And there is noise that affects their profits that's IID across firms and time.
Okay.
Then, in response to those two shocks, managers are going to solve an infinite horizon dynamic optimization problem. They care both about the long-term value of the firm. They have an ownership stake in it, and they're going to face some short-term pressure to meet earnings targets. These endogenous earnings targets. They're going to choose both R&D as well as what I would call, to an econ audience, paper manipulation, accruals manipulation. So they've got like an accruals manipulation choice here as well. Okay. So that's what's going on in the model. I'll tell you about what I find in a second, but you can let me, with that preliminary in place, address what you described. So exogenously, firms are going to face a shock to their profits that's IID, something like additive. Okay. That's IID across firms and time. However, the endogenous response of firms that are manipulating their profits to that exogenous IID shock can lead to interesting intertemporal patterns, both in the nature of profits and investment. And so you will see, for example, that there would be kind of unusually high levels of profits if it's being manipulated very quickly that revert, okay, because of not the shock, which is IID noise over time, but the endogenous response. Okay, so I could speak to, I know there's an incredible amount of richness on the accounting literature in understanding the intertemporal dynamics of earnings. I could speak to that within the model, but it's coming from the endogenous stuff, not the shocks.
Okay, cool. I got it. Thank you.
Perfect.
Stephen, I'm afraid that you're very popular and we do have more questions.
So like I said, this is what I do in the paper. So once I get through this slide, I'm golden.
Very good. Excellent.
It's fine.
Okay,
I'm learning from this conversation. So this is great. Yeah. Also, by the way, just as a comment, I have found that accounting researchers broadly pay a heck of a lot more attention to papers ahead of time than economists do. So I'm very cognizant that you guys probably know much more about my paper than a typical audience would. So I'm already learning something from this interaction. So ask away.
Okay, so shall we go ahead with questions? Is that all right?
Please. Yeah, please.
Okay, so I believe that, Paul Jarwin, has posted a couple of comments, but I was wondering whether, he would like to really talk about these comments himself. Paul, can you hear us?
Yeah, I'm here. I'm sorry. I have there's a noise in the background. Do you want me to ask my question?
Oh, I mean, you would like to ask your questions, so I can read them. I mean,
I'll wait. Let Stephen go, and I'll wait till he gets some more done. Okay.
Okay. So you wait. Fine. So, all right. So, I mean, after Paul, I think there is Stephen Penman as well.
Well, I don't want to keep you. I want to really get to your model and see what you're going on. But one thing I might raise, and others in the audience may have an answer to this, so it's more of a comment. We think ID is sort of a cash payment that you can make this period or not. But a lot of R&D is actually is plant and equipment, which actually is run through as depreciation. There are contracts with your senior researchers that you can't get out of. Maybe there's a few lab rats you can fire, but the question is how much of it really is discretionary. In accounting research, we presume that's actually discretionary. It's a cash expenditure, but it's not. But I say this to point out that if you actually could petition, get some information on that, maybe the mature farmies, they're committed to their programs and there's not much discretion, whereas a young R&D outfit, there may be much more discretion in terms, and so petitioning on that may be a worthwhile something to do when you come to empirical work.
That's right. So I want to echo that. So there's there are a lot of different categories of R&D spending that you see in practice. Of course, the standard financial statements don't always break those down, but there are comprehensive surveys run by the National Science Foundation in the US of kind of large scale R&D that takes place, something that kind of used to be called the Burdess survey that does exist at the firm and establishment level and has rich breakdowns. So, that's something that's accessible with like census RDCs. And, in the past, I'm on projects that have access to that type of R&D microdata, but you can just look at kind of without getting into the confidential stuff, you can just look at tabulations of what makes up R&D expense. And you see that exactly what you just described is very much the case, that a lot of R&D expenses here represent salaries of very specialized workers. There is some portion of R&D spending that represents, kind of equipment that doesn't have other uses and couldn't otherwise, be used elsewhere. That's actually fairly small as a fraction of the things that are counted as R&D expenses. So salaries are basically 70% of what we're talking about here. So whether you think of salaries as particularly adjustable or not, I think is a matter of much debate in the firm dynamics literature and labor econ, at least. But it is what it is. A lot of this is labor. I think those distinctions are interesting. I have very little to say with CompuStat about that. Yeah.
Yeah. I think Oliver as well. Oliver Beans has a question.
Okay.
Yeah. Hey, Stephen. Just one question. So, very interesting paper. I think it's an interesting approach that you aggregate up and then look at the macro consequences. However, I was also thinking about the other way around. So what we see a lot. So I spent a bit on that and on the data. So we see that firms ramp up a lot their R&D spending in crisis periods, so when earnings are already really bad, right? And then later, like the better periods, like they presumably cut R&D maybe because of short-term pressures. So I was wondering whether you kind of have considered that interactive relationship between aggregate shocks that induce, for example, depressions or whatsoever, that then incentivizes, so speaking, R&D, and then how that would kind of play out when both these IID shocks you were talking about earlier and these aggregate shocks are present.
That's right. So thanks for the question. So there's a rich vein of work in business cycle macroeconomics that basically takes very seriously the idea that you just described, that downturns at the macro level may be a particularly good time to engage in long-term investments of various sorts like R&D, both because future times are likely to be better than today, and so your prospects are looking up. Also because things like input prices and the cost of those investments may decline with the cycle as a whole. There's a debate about whether that effect dominates on average for firms, or whether things like financial constraints, which tighten during downturns, dominate. The typical, my reading of the business cycle literature is that on average, the thing that dominates is financial frictions, and you get drops in R&D. And it is mildly pro-cyclical, but less pro-cyclical than other quantities, perhaps less pro-cyclical for the reasons you just described. A model of the sort I'm building would have something to say about aggregate shocks if I added them. Right now, I'm not. I've kind of got a very constant, smooth growth path with shocks at the micro level. I could speak to that, but basically, I haven't here, even though I think it's a fascinating question. I'm glad you raised it.
I think, it is kind of potentially interesting, because I think in contrast to these previous studies that you're describing, where you have like these very real drivers here that would kind of build up on your story, and would kind of be this opposite of what you're describing, right? So in the bad times, you basically take the big bath so that you build a reserve then later. So I was just wondering how that kind of mapped in there, but
okay, so you're talking about the bad times on average, but I don't have that in the model. But one thing I want to highlight, this thing about big baths, it's not the first time I've come across this. The model naturally delivers it. Okay, so if you've got a fixed threshold, you want to meet a target, and there's some cost to failing to meet that target, you're going to cut your R&D to try to meet the target if you're around it. But if you know you're not going to meet the target regardless of what you do, if it's bad times at the firm level rather than the aggregate level, in this model, you might as well crank up your R&D, take a big bath today, put yourself in a better position in terms of fundamentals and profits to beat tomorrow. Okay, that's basically what the model does. The model will generate a big bath based on firm level shocks. If there was a recessionary correlated shock across firms, you might see this similar type of behavior. So I couldn't agree more that type of dynamic appears to be something we see in the data with like negatively skewed forecast errors and big baths. I have that in my model. So like, yes, I agree. So at this point, let me go ahead and actually tell you what I do with this model. I got this framework in hand. Why am I here? What do I do? Why would I build this model? Well, I've got this theory in hand, and in the third step of the paper, I'm going to estimate the model. I'm going to get parameters I can plug into it. I'm going to take it to that micro data that we started with. I'm going to estimate things like the persistences and volatilities of shocks hitting firms and the amount of pressure on firms to meet short-term targets. And with this estimated model in hand, I can do the following exercise. I can compare the world we see, the world with short-term pressures, to one where I remove short-term pressures from firms. And that's going to have consequences, that removal, at both the micro and macro levels. Okay? And what I see when I measure the costs of short-termism, or the impact of short-termism, which is what I'll describe the impact of these short-term profit pressures in the model as, is that at the micro level, short-term profit pressure generates more volatile R&D. So it doesn't actually change the mean of R&D much. So if a firm persistently cut its R&D, profit forecasts would adjust, basically. But it adds noise to R&D. So you get more volatile processes, and that in and of itself in this model is a source of misallocation that matters at the macro level. It also matters on average for firms and results in something like a 1% loss in firm value on average. Okay. At the macro level, though, we see about a little under 10 basis points lower growth per year. Full stop. If you're not used to thinking about growth rates, 10 basis points is big, not small. Okay, or it's moderately big, not small. Okay, and something like 0.5% lower welfare for an aggregate household in this economy. Another stop. If you're not a macroeconomist thinking about welfare numbers quantitatively all the time, 0.5% welfare loss is big, not small. It's in the ballpark of business cycle costs, for example. Okay. So this is something that matters at the firm level in the sense of driving lost firm value, something that can matter at the macro level in terms of driving lost growth in firm welfare or consumer welfare. So those are the costs of short-termism in this model. And the nature of that exercise is to say, I see discontinuities in the data. Let me just exogenously put in an incentive in manager forecast and manager payoffs that generates that type of short-term pressure. I haven't yet told you where they come from. This is all exogenous, and especially in light of Young's question, there's a natural question, which is where does this come from? And so in the final part of the paper, maybe I'll get to it today, maybe I won't. In this presentation, I extend manager incentives to include agency conflicts, either shirking problems or empire building problems that can relate to their desire to do R&D or their desire to exert effort. And I show in the presence of those agency conflicts that these types of short-term profit targets can actually be a tool for alleviating the underlying agency conflict and that they can actually raise firm value by alleviating agency conflicts, even if they lead to cost in terms of long-term growth and welfare in certain circumstances. But the picture is much kind of richer, and you have to think more carefully about what things like firm value and welfare mean in that context with the agency conflicts. So I do have something to say about that. So let me go ahead and dive in, not to a bunch of literature. Let me just say I read a lot of accounting papers and owe a tremendous debt to the literature on real and accruals manipulation of earnings. Okay, I'm very aware of that debt. What I also want to say a little bit briefly about is the data that I'm using, which should be familiar to an accounting audience. Okay, and in particular, the data that I'm using is quite standard in this context. I'm taking forecasts from IBIS. These are firm fiscal year forecasts. And I'm also mirroring those analyst forecasts to data from CompuStat, ExecAccount, and CRISP, very standard sources of information on US public firms. All at the end, when I merge these things together, I'm going to have a panel, spanning several decades, about 25,000 firm fiscal years for thousands of primarily, as you would guess, fairly large firms. All right, for these firms, I observe things like realized profits, consensus analyst forecasts, long-term investment, stock returns, and so on.
Stephen, just a quick question, just to clarify. Sure. And I think, I'm not really taking ownership of this, but, I mean, this is Paul Zaravin's, and I'm not so sure if he'd like to, take this point himself. His comment is that this paper is about public firms, or, do we have private firms? Because, Paul Zaravin says that, private firms are immune from the quarterly, pressures, and then we don't have a similar, we have a problem here. I mean,
that's right. So I appreciate that question. So thanks so much for highlighting it. And this is a great place to talk about it, given that I am indeed disciplining all of this evidence based on public firms. So of course, private firms don't publicly release their profits. They don't have consensus analyst forecasts and are not subject to exactly this type of short-term pressure. Okay. So there are two things I want to say about that, although there's an inherent limit to what I can say about it. Okay. So the first thing is that if you imagine that private firms, and I think this is a strong assumption itself, are not subject to any type of short-term pressure from any types of other internal benchmarks, okay, if you imagine that private firms are not subject to short-term pressures, then what you would see is an economy made up of two groups of firms, private firms and public firms, and there would be a firm life cycle and an enriched model that tried to take this into account. And firms that were private today, not subject to short-term pressure, would trade off two things when they were considering an IPO in an extended model. They would trade off the richer access to financing that comes after an IPO against the extra short-term pressure. And what you would get is that these types of short-term pressures would cause a distortion to firm life cycles. So more firms would stay private longer to avoid these types of short-term pressures than they otherwise would. And that would have an impact on optimal firm life cycles and potentially an impact on things like financing conditions and broad aggregate output through a different channel. Okay. But the point remains, like it is very much the case that private firms aren't subject to this type of thing. And so to the extent that that is true, the conclusions I'm drawing here could be an overstatement of the quantitative magnitude of this particular channel. I'm not just going to end by trashing my own work like that, though. I want to say one thing finally, which is that public firms are an overwhelmingly large share of R&D. Even if small private firms do a lot of it, they are small. Okay? And public firms are doing a tremendous amount. And so I'm capturing, when I was on the market, I would know these numbers off the top of my head. I'm capturing, I think, over 2/3 of R&D in this sample. It's a tremendous amount of R&D. So it's not clear that the omission is as broad as it first appears. But absolutely, these are public firms, not private firms, and that's going to limit the extent to which I can draw conclusions. Agreed. All right. So let me show you. Oh, please go ahead.
I have a follow-up question based on what you talk about. So think about, like, in the economy, what would be the ideal source of funding for R&D innovative activity? Is it short-term public equity capital, or is kind of like more long-term non-for-profit governmental funding? That I know this is a little deviating from your paper, but like I've been thinking about and also reading your paper with your advisor. That's how do we drive innovative activities in the society? And then one question I have is, what would be the ideal funding source, right? Is it publicly traded company equity who actually subject to short-termism would be the ideal source of funding for long-term R&D activities, or actually other funding will actually create better, kind of more optimal productivity and also social welfare.
So I think the question you're asking opens up a line of investigation that I think is important, and I think may very well lead to kind of stark conclusions that could have important policy implications. So the idea that public capital markets can be very good at kind of having low cost capital in general, but come with short-term distortions that are bad for certain types of long-term investments would definitely be the type of lesson that a model of the class I'm writing down that had both public and private firms would imply. And you could think about separately modeling more long-term funding sources versus these short-term sources. And I think that's an interesting avenue for future research. It's not necessarily the case that it's, this is not hypothetical at all. And there's good data both in the US as private sources of fundings become increasingly important for large private firms, but also across countries. Some countries have much more bank-centered, potentially more long-term funding models than other countries that are more based on like the Anglo-Saxon short-term capital market approach too. So both within the US context and across countries, there's a lot of data that could be used to attack this type of question. I think it's important and interesting, even though I don't have anything to say about it in this paper.
Thank
you.
Yes.
So, so what's the, what am I going to do with this data? Well, before I show you the model, I'm going to do a simple thing with it. I'm going to show you 5 differences in means. So this table has 5 columns. If you look at the top, there's a variable label, and the column has a number. That number is the locally and non-parametrically estimated difference in the conditional mean of the indicated variable between firms that just meet or beat earnings targets versus firms that don't. Okay, so what I'm doing is I'm using some sort of like non-parametric discontinuity estimate. So in the first column, what we see is 0.035 without much precision at all. So there I'm looking at the tangible investment rate. And this is, it's not fully something like a placebo check, but because tangible investment is capitalized over time, it has a very different relationship with profits than expensed R&D does. And we actually see that there's very little difference in tangible investment between firms that just meet and beat targets versus firms that don't. So that's the first number we see. The second 2 columns, or columns 2 and 3 rather, switch from a notion of tangible investment that's capitalized to intangible investment. So column 2 is looking at differences in the growth rate of what I'm calling intangibles. I'm just kind of borrowing this from the kind of recent applied dynamic corporate finance literature that calls SG&A some form of intangible investment. This is just SG&A growth. Okay, so SG&A growth is systematically lower by 2.7 percentage points for firms that just meet versus failing to meet earnings targets. It's a meaningful cut of around a quarter relative to the mean. This is a local cut. If you specialize to R&D as a form of intangible investment in column 3, you see that R&D is about 2.6 percentage points lower for those firms that just meet versus just failing to meet targets. Again, it's a meaningful drop, in this case, of about a third relative to average R&D growth. So these first 3 columns are showing us some discontinuities. It's just differences in means. I'm not showing anything or claiming causality. These are differences in means that are consistent with the idea that long-term investment is cut by some firms as a way to achieve narrow meet or beat events. Okay. Now, one reason you might think firms might do this is if their managers, the firm as a whole, face some incentives to do so. So if you look at CEO pay, or the kind of firm's overall stock returns in columns 4 and 5, for those firms that just meet or beat, these are fairly well known, all of these patterns in accounting. So I'm not claiming that it's new, I'm just setting the stage. You're going to see that CEO pay is discontinuously higher, and that so are firm stock returns. Okay. So firms may themselves face, and managers, the data is consistent with the idea that they face systematic pressures to meet or beat earnings targets. Okay. So we've got some differences in means consistent with the idea that something smells funny here. Okay, there could be something going on, right? And with long-term investment as a form of real earnings manipulation. So this is all my way of summarizing a rich accounting literature. Let me just put it that way. Where do I come in? I'm going to take this and I'm going to build a model up to try to make counterfactuals about the macroeconomy. My contribution is to say, in light of this type of motivating evidence, if we embed a model, does that model have something to tell us about what the macro impact is? Okay, so that's where I come in. So let me to the model itself that I'm going to build. The model is going to have two big blocks. Okay? The first block, and I'm going to shove it all on one page, has all the macro stuff. Okay, so this is the boring macro stuff. We're going to get to the exciting individual firm stuff and the accounting stuff in just a second. But at the macro level, I have to dot my I's and cross my T's to talk about what I mean by the macroeconomy. And what I mean by the macroeconomy is a household out there that's solving some sort of utility maximization problem and owns all of the firms. Okay, and they kind of get dividends from all of the firms and they eat yummy, yummy output that the firms produce. Okay, and I have a well-defined way of talking about a representative household here along a balanced growth path with a standard consumption savings problem that both funds firms and dictates household intertemporal payoffs. I also am going to have a final goods sector. And what I mean by a final goods sector is basically some big production function I'll call YT that represents GDP. I assume it's run by some firm I could call a representative or a final goods firm. But this firm produces GDP YT by combining labor that comes from the household and a continuum of intermediate varieties J in some amount XJT. Okay. Now, the action in this model is going to occur within intermediate goods firms, each of which is indexed by a variety label that J. So each firm is a variety or J itself. And altogether, their total output produces GDP. Okay. Now, it's not just the case that the output of the firm is what matters for aggregate output. It is also the case that each firm is going to produce their good, their own differentiated variety of intermediate good in the amount xj, but there's some quality associated with that good itself, how useful that good is in production. So QJT for firm J at time T is how impactful or how useful firm J's good is in driving aggregate output. Over time, growth for all of the firms in their quality is basically going to boost their productivity and boost growth for the economy as a whole. So endogenous growth in this model comes from growth in this Q object, this quality object for firms. Each firm is also buffeted by two shocks. There's a persistent and transitory shock, AJT and epsilon JT, that govern its usefulness in final goods production. I'll describe those more in a second when I get to the firm problem. Okay, but this is all of the macro side of the model. You don't even actually have to pay too much attention to the details. Just know that there's a household that earns everything. GDP comes from adding up output across firms. Individual firms have some sort of quality level that grows over time, and they're hit by some shocks. That's all we've learned from this. Okay. What really is interesting here is what's happening at the micro level. Okay. And within macro, there are these waves of like fashionable research. So I am in the latest wave of fashionable research in econ in the last 10 years in macro, which is I'm a micro to macro person, right? Which means I build models that have a micro structure added up and you learn something about the macroeconomy. So the action is always at the micro level. That's what I'm about to tell you about in this model. The action is at individual intermediate goods firms that both make long-term investments and have profits and profit pressures. Let me tell you about those. That's where the exciting stuff is. All right, so I'm going to have a continuum of intermediate goods firms that are faced by a couple of different types of shocks. One is a persistent shock to their profitability, AJT. That's going to follow an AR process. When this shock is high, they should be doing a lot of R&D. When it's low, they should be doing less R&D, both for the purposes of their own firm value and aggregate GDP. There's also a transitory shock that's going to affect their profitability. Just IID, I'll call that epsilon JT over time. The sum of those two things kind of induces shifts in their observed probability. So those are the shocks they face. That's all exogenous, and it's IID across firms and time, and there are no aggregate shocks. Individual firms are endogenously going to be growing their quality ladder level, QGT. So endogenous growth models, these models that talk about R&D driving growth of the economy as a whole, have to tell you what R&D does. And this class of endogenous growth models is called a quality ladder model, which means each firm has a quality of its output. Call that Q. And by engaging in R&D investment, Z, and I'm scaling that by Q here, so little z is like an R&D intensity. By engaging in R&D investment, this firm can move up a quality ladder, which means get a higher value of quality, lambda times Q, where lambda is greater than 1, with some probability. Okay, so a firm goes out there and engages in R&D with the total expense, little z times Q, and they're going to get a probability, phi of z, okay, something that is this function, this constant elasticity function of R&D, they're going to have some probability that's increasing in their R&D intensity of getting movement up a quality ladder and getting growth at the firm level. Okay, so what's happening? Firms are hit by transitory and persistent shocks, engage in R&D to grow their quality level, and we also need to talk about profits and accounting because that's the fundamental stuff, what's happening on the profit side. So street earnings are just variable profits from producing something and selling it to that final goods sector. You can think of this as just an expression that has math I don't get into that increases in the value of this A and E. Okay. Then you're going to, from these variable profits, like operating profits, you're going to have R&D costs. Okay, so R&D is fully expensed from profits. It comes fully out of profits. I'm going to allow for some manipulation or accruals manipulation. I'll call that M in just a second. I'll tell you more about the problem that determines it, but there's some ability to just bias reported profits away from the true underlying fundamentals. I'm going to assume that firms face profits of their earnings that evolve over time. The way I'm going to assume that this works is that there are rational forecasts of profits for a firm tomorrow. So forecasted value of firm J's profits in T+1 are just the conditional expectation of profits tomorrow given profits today. So the information set I'm giving forecasters is profits today, and they're going to rationally forecast profits tomorrow given firm behavior. So that's what I'm going to assume here. So I'm making assumptions about the information set. I've just told you how firms work. I haven't actually told you anything about the problem managers are solving. Managers are going to solve a problem that relates to the maximization of the expected PDV of their payoffs. So I'm going to assume managers are risk neutral. They face some constant real interest rate R, and they care about their own payoffs, DM of manager of firm J in time T. So DM is the payoffs of the manager of that firm. They're going to have some sort of claim, theta D, or some ownership stake in the firm. So they have some claim to firm dividends. So if managers just owned firm dividends, this would be a standard value maximization problem, obviously. However, I'm going to assume that there's some cost that the managers face, and it's parameterized by this parameter psi here, that a manager perceives and faces if their earnings fall below forecasts in a given period. Okay, and so this is a fixed cost. So how does this work? Well, managers solve this manager value maximization problem. Each period, they care about firm dividends, but they get whacked on the head if they miss an earnings target. That's what this model says. Okay, but how much do they get whacked in the head by? This parameter psi. And firm dividends are very standard here. They're just variable profits minus R&D. I'm going to assume that there's some cost to the accruals manipulation, some sort of quadratic cost that makes that an interior problem. All right. So what have I built here? At this point, I've built a model with a bunch of shocks hitting firms and two choices that firms make, their R&D choice and their accruals manipulation choice, both to maximize the expected PDV of dividends, but also to avoid getting whacked on the head by missing an earnings target. Okay, and I have kind of parameters that dictate the relative quantitative importance of each of these forces. So that's the structure I have in hand here. All right. So let me take this model to the data. I have a bunch of parameters. I need to plug it into this model. In classic macro style, I'm going to fix some of those parameters to conventional values. I'll call that calibration. And then I'm going to structurally estimate, conditional upon that calibration of these standard parameters in the top table. I'm going to structurally estimate according to a GMM exercise, matching some micro moments, the shock process at firms, kind of the parameters of the R&D process, the manipulation cost parameters, and the cost of missing an earnings target. So I'm going to do this according to a GMM exercise. So I'm going to match the model moments as well as possible to a set of data moments that include at the micro level, the covariance matrix of R&D growth, sales growth, and forecast errors, as well as at the macro level, the average growth rate of the economy. As you might expect, things like the correlation of R&D growth and profits tell me a lot about the amount of pressure out there in the model that I'm working with, for example. And so, you know, in the paper, I spent a great deal of time talking about identification. The actual point estimates that I get out of this GMM exercise and their standard errors are reported on this page. What I want to highlight, if you're not a person that writes down, estimates dynamic corporate finance style investment models on CompuStat all day long, is that these parameters are fairly conventional in a set of firm level investment problems, whether it's tangible or intangible investment. The persistent component of profitability shocks is quite persistent, high autocorrelation. Volatility hitting the firm is about evenly split between transitory and persistent sources. And I'm estimating a value of this psi parameter, the amount of total short-term pressure on firms to meet profit targets, that is positive. Now it's in model units, so this cost of missing an earnings target, you have to translate it to something to figure out what it means. At these parameters, a manager, I am estimating, would be indifferent between missing an earnings target and something like 3% lower revenue in the same year. So it's a meaningful amount of pressure on managers to meet earnings targets. That's kind of their perceived short-term pressure. It's implied that these types of parameters. I care less, though, about the actual parameters themselves, the values of these things, compared to the consequences of short-term pressure in this model, because that's what I'm here for. So what I do is I compare this economy with an estimated set of firm-level parameters and pressure to meet short-term targets to a counterfactual economy where I turn off pressure to meet short-term targets. And by comparing those two, I can get a sense of what this short-term pressure does, both at the micro and macro levels. So let's look. First thing you can see is that when you look at the forecast error distribution in red for the model with short-term pressure versus in black for the model without short-term pressure, that counterfactual without any earnings targets, whatsoever, you're going to see that forecast errors in the estimated model display the types of characteristics you'd expect. They have bunching above zero and a hollowing out of the distribution below zero. This type of pattern is untargeted, but naturally generated by the types of short-term pressure I've inserted into the model. That's the model in red with short-term pressure. The model in black that doesn't have short-term pressure, as you'd expect, has a smooth earnings distribution across the zero forecast error threshold.
Steven, we have 5 minutes.
Yep.
Okay.
Perfect. Thank you. So the way that this works in the background is that if I look at a given level of forecast errors on the horizontal axis, and I ask myself, what is the R&D choice that a firm makes given that level of forecast error in the model with or without earnings targets? I can plot that in red and black on this graph. So what you're going to see is that this model with short-term pressure delivers endogenously the patterns that we saw at the start of the paper in the data, which is that firms that just meet earnings targets have systematically and unusually low levels of R&D growth in the model with pressure in this red line. The model without pressure has smooth R&D growth across that threshold, the black line. You also see as an aside that firms that know they're going to have really low profits with very low forecast errors have very high R&D growth because they're taking big baths, which relates to a question we just saw. But basically, this means that with short-term pressures, firms are alternating between sometimes cutting their R&D to meet an earnings target, sometimes increasing it as part of a big bath or for firms that are way above the target. And so this alternation adds noise to R&D processes at the firm level. And at the macro level, when you add up all of this information, delivers the following implication. So the economy with targets grows at about 2.25% per year. The economy without short-term pressure goes by about 5.3% per year. So this is it. This is the headline number. I have something like 6 basis points less growth per year in an economy with short-term pressure than in an economy without short-term pressure. So you're going to ask yourself, is 6 basis points of growth something that matters at all? The answer is absolutely, because this is compounding. It's for the entire economy as a whole, and it compounds each year. If you discount that in an appropriate way for individual firms, their own value would go up by about 1% if you removed short-term pressure. Household welfare would go up by about 0.5 percentage point if you removed pressure, taking into account discounting of these growth rates. These are both big numbers. If you look at the dynamic corporate finance literature, value movements of a percentage point or more reflect meaningful distortions, and welfare changes of like 0.5 percentage point of consumption each year from short-term pressure is huge. That's something on par with something like the cost of business cycles. So this on its face kind of validates some of the traditional concerns that people have had with short-termism and suggests that they are coherent in a macro model, that you add up observed behavior at the firm level and you get kind of meaningful macro distortions from these types of targets. Okay. So at this point, I'm going to go ahead and skip everything about the agency conflicts because I want to make sure I end on time here and just say, I see discontinuities in the data. I can put a model of short-termism and endogenous growth on the table. Short-term targets reduce aggregate growth. Okay, so that's what I've learned from this exercise. And because I have now reached the end of my time, I actually don't necessarily want to talk about the accounting design stuff, but I can just pause here and say, thanks so much for being here, and you should definitely come to the next meeting of the accounting design project with information here.
Thank you.
Stephen.
Thank you. Thank you very much.
I missed a few minutes because my laptop died, but it's all right.